Linear regression channels are powerful technical analysis tools used by traders and analysts in financial markets. They help identify potential support and resistance levels based on statistical analysis of price movements. To understand linear regression channels, let's first look at a series of price data points on a chart. Each point represents the price of a financial asset at a specific time. The core of a linear regression channel is the regression line, which represents the best fit line through all price points. This line minimizes the total distance between itself and all price points, representing the average price path. To create the channel, we add two parallel lines above and below the regression line, typically set at a distance of 2 standard deviations. The upper channel line acts as a resistance level, where prices often struggle to move higher. The lower channel line serves as a support level, where prices frequently bounce back up. Unlike traditional trend lines that connect specific price points, linear regression channels are mathematically robust. They use statistical analysis of all price data points. In summary, a linear regression channel provides traders with a visual representation of the average price path and potential price boundaries, offering a more mathematically robust tool than traditional trend lines. The mathematics behind linear regression channels starts with the least squares method. This method finds the best fitting straight line through price data points. Mathematically, we seek to minimize the sum of squared distances between the line and all price points. These vertical distances represent the errors between actual prices and our predicted line. The slope and intercept of our regression line are calculated using these formulas. This gives us our middle regression line, where y equals m times x plus b. The upper and lower channel lines are typically placed at a specific standard deviation distance from the middle line. Most commonly, these boundaries are set at 2 standard deviations above and below the regression line. This statistical approach means the channel represents where prices have spent most of their time. The outer boundaries show statistical extremes where prices are more likely to reverse. Using 2 standard deviations captures approximately 95% of normal price movement, making the channel boundaries significant levels for potential trade decisions. To set up a linear regression channel, first select a relevant time period for analysis. Most trading platforms allow you to select a specific period that contains a clear trend or pattern. Next, calculate the linear regression line, which is the line of best fit through your price data. The regression line minimizes the distance between itself and all price points, creating the most accurate trend line. Then add parallel lines above and below at equal distances, typically set at 2 standard deviations from the regression line. The channel width can be adjusted based on market volatility. Wider channels for more volatile markets, narrower for less volatile ones. A 1 standard deviation channel is appropriate for less volatile markets. The standard 2 standard deviation setting captures approximately 95% of price action. For highly volatile markets, a 3 standard deviation setting may be more appropriate. The resulting channel should contain approximately 95% of price action when using the standard 2 standard deviation setting. You can visually verify this by checking how many price points fall within your channel. This completes the setup of your linear regression channel, which can now be used to analyze price movements and develop trading strategies. Trading channel bounces is one of the most effective strategies when using linear regression channels. First, let's visualize a price chart with our regression channel. When price touches or approaches the lower channel boundary, traders consider a buying opportunity. The first profit target is typically the middle regression line. This is a more conservative target with a higher probability of success. The second, more ambitious target is the upper channel line, offering greater profit potential but with lower probability. Conversely, when price reaches the upper channel boundary, traders look for selling opportunities. Again, the first target is the middle regression line, offering a balanced risk-reward ratio. And the second target is the lower channel line for those seeking larger profits. These channel bounce trades work best under specific conditions. First, the channel should not be too steep. Extremely steep channels often indicate unsustainable momentum. Second, the overall trend direction should be clear. Channels work best in established trends. Third, price should respect channel boundaries consistently. Look for multiple previous touches. And finally, volume should confirm price movements, increasing on channel bounces for higher reliability. Never enter a channel bounce trade without confirmation from additional indicators. Momentum oscillators like RSI or stochastic can identify overbought or oversold conditions at channel boundaries. Volume patterns should show increasing interest as price approaches channel boundaries. Look for candlestick reversal patterns like hammers at the lower channel or shooting stars at the upper channel. And finally, the strategy works best when channel lines align with existing support and resistance levels. Proper risk management is crucial for channel bounce strategies. Always place stop-loss orders just beyond the channel boundary to limit potential losses. Risk no more than 1 to 2% of your trading capital on any single channel bounce trade. Consider reducing your position size during choppy or uncertain market conditions. And consider taking partial profits at the first target, the middle line, to reduce risk on the remainder of the position. Channel breakouts occur when price moves decisively outside the established regression channel lines. First, let's establish our linear regression channel using historical price data. When price breaks decisively above the upper channel line, it signals stronger bullish momentum than the established trend would predict. For confirmation, look for increased trading volume during the breakout phase. A critical step is to wait for a retest of the broken channel line before entering a position. This often provides a better risk-reward entry. After a confirmed breakout and retest, price often continues in the breakout direction, potentially leading to an extended move. Here's a summary of the channel breakout strategy. Breakouts can occur in either direction. A break above the upper channel is bullish, while a break below the lower channel is bearish. Always confirm breakouts with increased volume, which shows stronger commitment from traders. Wait for a retest of the broken channel line to find an optimal entry with better risk management. After a successful breakout and retest, target an extended move in the breakout direction. Understanding how to trade channel breakouts provides a valuable strategy for capturing significant market moves when price action accelerates beyond the established trend. The choice of time frame significantly impacts the effectiveness of linear regression channels. Longer time frames, such as daily or weekly charts, typically produce more reliable channels with fewer false signals. These longer time frames are often suitable for position trading, where trades are held for weeks or months. Shorter time frames, such as hourly or 15-minute charts, create more trading opportunities but come with lower reliability. Notice how the short time frame chart shows more volatility and potentially more signals, making it appropriate for day trading. Many traders use multiple time frame analysis to improve their trading decisions. Traders use longer-term channels to determine the overall trend direction. Then, they use shorter-term channels to time their entries and exits with greater precision. Remember that the choice of time frame should align with your trading style and objectives. Let's examine the common pitfalls and limitations of linear regression channels. The first major limitation is the linear assumption. Linear regression channels assume price movements follow a linear relationship, which isn't always accurate in financial markets. Financial markets often exhibit nonlinear behavior, especially during parabolic runs or market cycle transitions. When prices move exponentially, the linear channel fails to capture the true market dynamics. Another significant limitation is how channels fail during strong trend changes or market shocks. The calculated channel often continues in the previous direction, even when the market has already reversed. Here we can see how the regression channel misrepresents the true market direction after a trend reversal. This creates false signals and can lead to significant losses if followed blindly. Choosing the wrong time frame or period length is another common mistake that can create misleading channels and generate false trading signals. Looking at these price data points, we can see how different time frame selections produce completely different channels. The long-term channel shows a moderate uptrend, while the short-term channel indicates a much steeper uptrend. In ranging markets, regression channels may be too flat to provide useful trading signals and can miss important support and resistance levels. Notice how the linear regression channel is nearly horizontal and fails to identify the actual support and resistance levels that are defining the range. Trading based on this channel might lead to poor entry and exit points. Because of these limitations, it's crucial to implement proper risk management when using linear regression channels in your trading strategy. Always use additional confirmation indicators, proper stop-loss placement, and remember that no technical tool works in all market conditions. Combining linear regression channels with other analysis methods will produce more reliable results.